this video, we're going to discuss life insurance. This is from chapters 11 and 12 of the Rada McNamara text. First, let's start with the definition of life insurance. Life insurance can generally be defined as protection against the cost associated with death. So the peril in life insurance is death, but it's especially the untimely death of a family income earner. What this basically means is that a person's death protection needs generally change, in fact, can change dramatically over their lifetime. Take, for example, someone who is 17 and has a part-time job making a little bit of money, but no financial dependence. That person doesn't have significant death protection needs, because if that person were to die, while there would be funeral costs, there might not be other substantial costs associated with their death. Similarly, take a person who is 85, who has no debt, who does not have any financial dependence at this point. This person, again, doesn't have significant death protection needs. But a person who is 32, who has a job, a spouse, and 2 or 3 children, has significant death protection needs. So let's look now at examples of the cost of death. Burial and estate clearance is going to be a cost for any death, whether you're 17, 32, or 85. And these costs can vary pretty significantly. A funeral can cost between $5,000 and about $25,000. Estate clearance includes probate costs and possibly estate taxes. So this is the cost of clearing out and valuing your estate. And the larger the estate, generally, the larger the estate clearance costs. Then there's the family share of income earners' earnings. We'll talk about this more in a moment. Then there might be additional bills such as education for a surviving spouse and relocation if the family needs to relocate after the death of an insured, maybe to help with child care. Then some non-economic costs. Perhaps the family needs to travel to see other family members, and grief counseling. And then the cost of maintaining a business after a key person in the business, maybe a business partner. So this could be associated with a family or a non-family member. So let's look specifically at how much life insurance you should purchase. There are 3 alternative approaches to determining this, and I recommend that you should use all 3. In general, a life insurance agent or a financial planner will help you make the determination of how much life insurance to purchase. But it's always good to spend time alone and in consultation with members of your family and others who you trust to determine how much life insurance you need. The 3 approaches are the human life value approach, the needs approach, and the capital retention approach. Let's start with the human life value approach. Human life value defined is the present value of the family's share of the breadwinner's earnings. Or, in other words, what would the family be giving up if the breadwinner or income earner would die suddenly? Or, how much is the breadwinner going to make for the rest of their life, minus the amount that they would spend on themselves? Let's look at the steps to calculating the human life value. First, you would determine the average annual salary. So you might pick $120,000 as an average. Then you would subtract the income earner's share. This amount is the amount that would be spent currently on the income earner, but would no longer need to be spent if the income earner is deceased. And I picked $40,000. So the remaining amount, or the amount that you would want every year for the family, is $80,000. Then you would determine the number of working years remaining. In this case, let's pick 35. And a reasonable interest rate. This would be an interest rate that you think very conservatively you could earn by investing the death benefit and living off the payment until it's drawn down to nothing after 35 years. Then you would calculate the present value of this using $80,000 as the payment, 35 as in, and 2.5% as I. Or, specifically, if you're using Excel's financial formula function, your result is approximately $1.9 million. This means that for a family to have $80,000 a year for 35 years, the family would need to purchase $1.9 million on that individual as the insured. Now let's look at the needs approach. With the needs approach, you determine what needs your family or survivors or your business will have after your death, and you must determine the amount and timing of those needs. Or in other words, you need to ask which ones will end if I, that is the insured, outlive them, and when will they end. So for example, the estate clearance need. This is actually a need that almost never ends. In fact, it gets a bit larger as you age and as your estate increases. Then additional income during periods of readjustment. This is especially important when you have individuals who are financially dependent upon you. Usually, a family needs extra income during the first 2 to 3 years after the death of a family income earner. Things like relocation and education and just general readjustment, and not having to worry about bills as much during that period of grieving. And then income during the dependency period. This is the period where children are financially dependent on you or other dependents. Often part of that is considered to be a college fund. Then a lifetime income to a surviving spouse. Once a retirement has been fully funded, it may not be necessary to provide the lifetime income to a surviving spouse, or that amount may just need to supplement the retirement. Related to that, any retirement needs that haven't been met. Now let's look at the capital retention approach. It will yield the highest amount, but it would be considered the safest for survivors. You would start with one of the other two approaches to determine how much money you want your family to have each year, and then you would divide that amount by a reasonable interest rate. And you assume that your family will live off or receive every year the interest on that lump sum. So, for example, going back to our earlier example, you want $80,000 per year for your surviving family, and you think a reasonable interest rate is 2.5%. So, 80,000 divided by 0.025 gives you $3,200,000. $3,200,000 is how much life insurance you would need to purchase to give your family $80,000 per year without ever depleting the principal. The danger in only buying the $1.9 million that we discussed earlier is that at the end of 35 years, there's no cash for the family to live on if they still need money at the end of that time. But this is dependent on the individual and family's own preferences. Now let's discuss the basic types of life insurance. There's term life insurance and whole life insurance. These are only two of several other types of life insurance, but they are by far the most common. There is also universal life insurance and variable life insurance. Just know that if you understand term life insurance and whole life insurance concepts and principles, you'll understand variable and universal, because especially whole life insurance is the foundation for other types of life insurance. Let's first discuss some important concepts related to life insurance before we look specifically at term and whole life. They are the parties involved in a life insurance contract, and insurability in life insurance. There are basically three parties involved in a life insurance contract, beginning with the insurance company. Then, of course, the insured. They are the person whose life on whom the insurance is written. And the beneficiary is the person who gets the death benefit when the insured dies. There's actually a possible fourth person who is the owner. The owner is the person who controls the policy before the insured's death. This means they can exercise any rights under the policy. They also generally initiate the policy, and some of the rights that they might exercise include dividend options and settlement options, which we'll talk about later in this lecture. But generally, the owner is the same as the insured. So, for example, a family breadwinner might decide to purchase life insurance on themselves and designate his or her spouse as the beneficiary, or possibly his or her children. An owner must have insurable interest in the insured to buy life insurance on them. And so it is possible for someone to buy life insurance on someone else and designate themselves the beneficiary. For example, a husband might purchase life insurance on his wife. His wife is the insured and he is the beneficiary. And a person always has insurable interest in themselves. So a person can purchase insurance with themselves as the insured and designate anyone they want to as the beneficiary. But back to this slide, there is a possibility that the owner is different from the beneficiary and the insured. This would be when, say, a parent is the owner, in other words, purchases the policy and designates another parent, let's say in this case the mom, as the insured, and designates a child or children as the beneficiary. In this case, you actually now have 4 parties to the contract: the father, who is the owner, the mom, who is the insured, and the child, who is the beneficiary. Now, you also might have other children. We'll talk about that more later. But this is the basic idea of the parties involved in the insurance contract. So let's now turn to insurability. It is the prospective insured's life that is in question. So it is that person, the prospective insured, who we're concerned with. A life is insurable when the insurer is willing to sell a policy on that life. This is, of course, based on the insurance company's perception of that person's mortality, or in other words, their belief about what age that person is expected to die. And, of course, people become uninsurable over time. While this is an obvious statement to most people, many people don't realize how easy it is to become uninsurable for life insurance. A person with high blood pressure, type 2 diabetes, really just any health condition that is an indication of what's called morbidity or someone's poor health can lead to someone becoming uninsurable. So it's always better to purchase insurance when you're younger and lock in that insurability. Let's look now at term life insurance. First, we'll look at how term life insurance is used. Then we'll look at term life insurance characteristics. And then we'll look at types of term insurance. Term insurance is for temporary needs. Say, for example, a college education, a loan payoff, and income during dependency. This is, of course, assuming that your children eventually are no longer dependent on you, at least not financially. And then anything else that ends if you outlive it. Let's look at term insurance characteristics. Term insurance is for needs that are not permanent, as I said. In other words, the insured outlives them. The premium is directly related to the chance of death or mortality, or also the probability of death. And, of course, the probability of death goes up over time. So this chart illustrates that. You have the death rate here on the y-axis, and on the x-axis, the insured's age and time. And it, of course, increases at an increasing rate, which means that at the beginning of the policy period, generally the line is relatively flat. It starts to increase, and then it actually ends at age 100. This doesn't mean that everyone is expected to have died at age 100 in real life, but the mortality tables do at this point show that everyone has died at age 100, or you have a 100% chance of death at age 100. This is also the insurance premium over time, because as I said, the premium is directly related to the chance of death, because of course the premium equals the probability or frequency or mortality times the severity, which is the death benefit. And so the two are directly related. Finally, let's look at types of term life insurance. The most common type of term life is yearly or annually renewable term, or commonly known as YRT or ART. This is a 1-year term policy that is automatically renewable. The term renewable means without evidence of insurability, or you can renew the policy without providing evidence of insurability. And by the way, how do you provide evidence of insurability? Well, in most cases, you actually have to have a physical examination, taking blood and urine samples and blood pressure and so forth, as well as an extensive questionnaire that you have to fill out about your medical history. So it is good to purchase annually renewable term. Generally, it will only be renewable to a certain age, such as age 65 or 70. There's also 5, 10, 15, and 20-year term, which might be good for needs like loans that are 5, 10, or 20 years, and term to age 65. This is partly because many life insurance needs end at age 65. As we discussed, you might have a fully funded retirement at age 65. And then you could simply have term tied to a loan, which is a decreasing face amount of term. The face amount of your policy would be decreasing based on the amount of principal outstanding. It actually decreases at an increasing rate because as you pay off a loan, continually pay off more principal. So it could be tied to a mortgage or a car loan or any other type of private loan that you might have, or business loan. And then there are some other kinds of decreasing term. In reality, most needs over your life are decreasing, such as the income during dependency period. As you've raised your children, the amount of money that you will need to spend on them declines over time. Now let's look at whole life insurance. This is for permanent needs, and we'll look at whole life characteristics. Examples of permanent needs include the estate clearance fund we discussed, and having an unending emergency fund or income during readjustment for your dependents. An emergency fund is things like paying for last-minute medical bills and any outstanding debt that the insured might have had that needs to be paid off, and an income to surviving spouse, which does go down over time, but it could be a permanent need. Whole life insurance can also be used for savings because it builds a cash value, which we'll talk about in just a moment. It's also known as cash value life insurance. And the other types of life insurance I mentioned, which were variable life and universal life insurance, are also cash value life insurance policies. Now let's look at whole life characteristics. Whole life insurance locks in insurability. This is a huge advantage to whole life because even with annually renewable term or any kind of renewable term, eventually you become uninsurable. But with whole life, as long as you continue to pay your premiums, you will continue to be insurable and the policy will continue to be in force. It's also forced savings for most people. Once you've established the life insurance policy, most people will continue to pay those premiums knowing they need to do so to maintain the life insurance. And because it builds cash value and you can cash out the policy cash value once it reaches a certain point, it is forced savings and can be used as a source of investment. So it is a low-risk investment. However, it's also a low-return investment, relatively speaking. It is very expensive, though, and we'll look at that in just a moment, where we compare the cost of whole life insurance to term insurance. But let's look now at how whole life insurance builds cash value. We're taking our same graph as before, but now I'll add the whole life insurance premium. Notice that it is a flat amount over time. The whole life insurance premium does not increase over time, but what does happen is that the owner of the policy overpays mortality in early years of the policy, and all of that money is invested so that during later years of the policy, the insurance company can afford to pay the underpayment. While this may not look like a lot of money, you'll see that it actually is quite significant. So with whole life, the overpayment in the early years of the policy are invested to make up for the underpayment in later years. If the owner forfeits or surrenders the policy, they get a return of some of what they invested plus interest. Some of that amount of money went to mortality or death benefits of people in your insured group that did not survive. This amount is known as the cash value, or sometimes surrender value, and we'll look at that more when we look at policy provisions. Now let's look at a comparison of term and whole life. So with term, the insurer owes the beneficiary and the owner nothing if the policy term expires before the insured's death, and you can become uninsurable, and people tend to become uninsurable over time. A solution is to get annually renewable term. However, this annually renewable feature will eventually expire. And term eventually does become cost prohibitive once you reach approximately age 70 or higher these days. Term insurance is no longer affordable. You'll see that in a moment. But the reality is, whole life insurance becomes extremely cost prohibitive as well if you don't purchase it early. term insurance is much cheaper than whole life. Whole life insurance does build cash value, locks in insurability, and is forced savings. Term life insurance has none of those features, but again, it is very expensive compared to term. We're going to look at a chart where we look over time at the term and whole life rates, and then I'll actually show you the premiums on the earlier calculation we made. Let's look at what I'm talking about. So age is the age that you are when you buy the insurance policy. And then we'll look at rates per thousand of life insurance coverage. So the rates for term insurance per $1,000 of coverage are $1.64, $1.65, $1.83, $3.35, $7.76, and then this is not applicable because term has become cost prohibitive now that you're 75. This, by the way, is for male non-smokers. Now let's compare this to whole life. At age 18, whole life would be $6.92, $8.85 at 25, $12.78 at 35, and $21.45 for $1,000 of coverage at 45, and $67.78 at age 55, and $128.20 per $1,000 of coverage at age 75. This, by the way, is all per year. But let's look now at the annual and monthly cost of these two types of life insurance for $1.9 million of coverage, which is just $1,900 times the cost per $1,000. So all I've done is divide the 1.9 by 1,000 to get to 1,900, and then I multiply it by the cost per 1,000 that I just listed for you. For term life insurance, the annual cost would be a little over $3,000. The monthly cost would be $260. This is for $1.9 million of coverage again. But for whole life, it would be an annual cost of over $13,000 and a monthly cost of about $1,000. At 25, the term cost would be $3,135 annually and $261 monthly. But for whole life, it's $16,000 and almost $1,500 monthly. At age 35, the cost would be $3,477 or $290 monthly. But for whole life, a little over $24,000 annually or $2,000 monthly. You can take a look at the rest of these on your own, but hopefully you get the point that for life insurance needs that are significant, whole life insurance is basically unaffordable. My recommendation is that if you have needs of approximately $2 million, that you actually buy a combination of whole life, which would be for needs like estate clearance and income to surviving spouse, or maybe any inheritance that you want to provide. But for the majority of needs which you outlive, term insurance is a better purchase. Now we're going to talk about life insurance provisions. This is primarily from Chapter 12 of the Rita McNamara text. We're going to start with a discussion of what I call the minor clauses. But just because these are minor clauses doesn't mean that they're not very important. First, the incontestable clause. This says that the company has 2 years during the lifetime of the insured to contest a policy. So if the insured dies after 2 years and the insurance company discovers that the insured lied about a health condition that he had, they cannot fail to pay the beneficiary the death benefit, or in other words, they can't cancel the policy. This protects a beneficiary from losing a life insurance policy after 2 years from the inception of the policy because of something the insurance company discovers. Then there's the entire contract clause. This says that the policy and application, and no more, constitute the entire agreement between the insured and the insurer. So the insurance company has to basically make everything clear about the policy in the policy itself. Then there's the misstatement of age or sex. This is actually an exception to both misrepresentations in an application and the incontestable clause. It says that the company will alter the face amount to what would have been paid if the applicant had been truthful. So, for example, if you apply for a life insurance policy and say that you're 28 when you're really 32. When they discover that you're 32, no matter how long the policy has been in force, they're going to reduce the face amount because you were actually older than you said you were at the time of the policy inception. Then there's the grace period. The grace period is anywhere from 30 to 61 days. The exact number of days will be stated in the policy to pay an overdue premium. If you go beyond that or lapse in your insurance policy, then you must go through the reinstatement conditions or reinstate the policy. Let's look at reinstatement provisions for a cash value policy. A policy automatically becomes a term policy if the premiums aren't paid. Again, we're talking about a cash value policy, so a whole life policy or one of the other alternatives I mentioned. If you fail to pay the premiums on a term policy, you just lose the policy after the grace period has expired. But in order to reinstate a cash value policy, you pay overdue premiums plus interest, and you have to provide evidence of insurability. The first one's sort of a no-brainer, but the second one might be the more difficult of the two. And then there's a third one, which is the cash value must not have been exhausted. Over time, the insurance company will use the remaining cash value to pay mortality charges. So you have to be sure and reinstate the policy within a certain period of time, depending on how much cash value you had when you stopped paying premiums. Next is the suicide clause. You might have heard of this one. The beneficiary only gets a refund of premiums paid in if the insured commits suicide within 1 or 2 years of policy inception. What kind of hazard is this preventing? It's obviously preventing a moral hazard, where someone has gotten into a financial bind and in order to try to protect their business or their family, they decide to kill themselves, but before they do, they purchase a policy. Now let's look at the ownership clause. Possible owners to a life insurance policy are the insured, the beneficiary, or a trust. A trust is typically going to be a law firm or a lawyer. Rights of ownership include the following: naming the beneficiary, surrendering the policy or giving it up or taking the cash value, which we'll look at in a moment, exercising dividend options, and exercising settlement options. We'll look at these last three during the rest of this lecture. But remember that either the owner or the beneficiary has to have insurable interest in the insured. Insurable interest exists if you're a close relation, such as a spouse, brother, sister, parent, or grandparent, but not an aunt or uncle or cousin. Or you have a fiduciary relationship, which is a sort of financial dependence, such as a business partnership. Then there's the beneficiary designation. There are different groupings of beneficiaries. In one policy, you're normally going to have a primary and at least one contingent beneficiary. The primary beneficiary is the person who gets the death benefit as long as they are still alive when the insured dies. But if the primary beneficiary dies before the insured, then the contingent beneficiary will get the death benefit. There is also the specific versus class designations. Normally, you name a specific person to be your beneficiary, but a class is when you name a group of people, and the death benefit is generally split evenly among the members of the class. This could be your employees or your children. If you simply name your children as the class of beneficiaries, the death benefit will be split among the children as each child is born. Then there's revocable versus irrevocable. A revocable beneficiary can be changed without the permission of the beneficiary. With an irrevocable beneficiary, you would have to get the beneficiary's permission to change the beneficiary. But if a benefit is paid to a named irrevocable beneficiary, the benefit does not pass through the estate. Some people like to have a revocable beneficiary because they like to be able to change their beneficiary after the inception of the life insurance policy. But in order to avoid estate taxes, the beneficiary must be named and irrevocable. And if you name a revocable beneficiary, the death benefit still goes through the estate before getting to the revocable beneficiary. In 2015, for example, estate taxes are 40% of the excess of $5.43 million. This might not sound like a lot, but if you have a $3 million retirement and a $3 million death benefit, you're already well over the $5.43 million threshold. Even if you're only $100,000 over that threshold, the federal government will take $40,000 of that $100,000. It's a very high tax rate. Next, let's briefly look at the policy loan provision. You can borrow up to the contractual cash value of the policy. One thing I haven't said about traditional whole life insurance is that you will actually know what your cash value will be at the end of every year at the very beginning of the policy. This can vary in certain other types of more innovative life insurance, but it is a big benefit of cash value life insurance. However, you must still meet mortality charges. If you fail to continue to pay premiums or to pay back the cash value, you might lapse in your policy and not be able to reinstate it since you've now exhausted the cash value. There's also the automatic premium loan. This is a feature that automatically borrows against your cash value to pay an overdue premium before a grace period ends. This keeps you from having to reinstate a policy because you've lapsed in the policy. This is a nice feature, particularly if you've become uninsurable, because remember that in order to reinstate a policy, you have to provide evidence of insurability. Now let's briefly look at non-forfeiture options. These are also known as surrender options. Again, this is when you have a cash value policy. And there are 3 ways of taking the cash value. First would be as a lump sum, but there are 2 alternatives to taking the cash value in a lump sum. One is reduced paid up insurance. Let's look at an example of how this would work. Let's say you had $1 million of whole life insurance, and then you decide to forfeit the policy. A reduced paid up option will use the cash value as a single premium to buy a lower amount of paid up whole life insurance. It might be $400,000, but now it's paid up. This can be very good for retired persons who maybe don't want to continue to pay their life insurance premiums, but they've also got much lower death benefit needs because their children are grown and most of their loans or all of their loans are paid off. Then there's extended term insurance. So say you had the $1 million of whole life insurance. This will use the cash value as a single premium to buy $1 million for 3 years of term insurance. So it allows you to buy the same amount of life insurance, but only for a certain period, and there will be no cash value left. This can actually be very dangerous, even though it might sound like a great option, because what if you outlive the 3-year term? However, it is the automatic option when a cash value life insurance policy is forfeited. The reduced paid up is the safest of the 3 if you still have a beneficiary that you need to protect. Then there's the settlement options. These are the different ways that a beneficiary can take the death benefit. First, they can just take it as cash, which is the most common. But the insurance company also allows you to leave the death benefit with them and pay out interest only. Or you can take it as a fixed annuity. You might designate a specific amount of the installment, or you might designate that they pay it for a fixed amount of time, say 10 years, or $1,000 a month. Once the money runs out, it runs out. But there's also a life income annuity on the beneficiary, which will pay a specific amount of money in an installment to the beneficiary until their death. Obviously, this will be a lower amount because it's also based on the beneficiary's mortality. The younger the beneficiary, the lower this amount will be. And last, let's look at dividend options. These are only going to exist if the policy is what's called participating. You could simply take the dividends as cash, or you could apply it against your premium. Or you could have dividends accumulate at interest. So this would be like a little savings account for you. Or you could have paid up additions, meaning small amounts of whole life insurance that basically just add to the death benefit of your policy. And extended term, which could actually double the amount of your life insurance, but only for 1 year. Most life insurance companies don't even offer this option. And that's the end of our discussion of life insurance.